Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this episode of the Moneymakers podcast, I talk to Ryan Lightfoot-Aminoff, who is an investment trust research analyst at Kepler Partners. I'm going to kick off, if I may, Ryan, by asking you about some interesting notes that you've done recently on trusts that follow a enhanced dividend policy. Perhaps for our listeners, you might kick off by reminding us what an enhanced dividend policy is, and then we'll go on to talk about those who adopted it and what the implications of that are in future investment returns.
Of course, Jonathan. Well, thank you for having me on. The enhanced dividend strategies are a way of boosting or increasing the yields from an investment trust, typically from asset classes not often associated with one. So they will use capital reserves to complement a portfolio's underlying or natural yield to pay an attractive or growing dividend from those asset classes. So asset classes that have seen it grow of late have been Asia smaller companies, and the UK and UK smaller companies as well. So for investors, especially for those who are in their income era of investing, it means that more asset classes are available that are in play really. So you can add an Asian smaller companies trust such as Aberdeen Asia Focus into your portfolio and get quite a decent yield from it without then having to compromise and chase yield elsewhere. It also means that investors can look at asset classes like growth-focused trusts, and you've got that capital growth potential in there, while still giving you a diversified income stream from some of the other areas, and then put that together in a whole portfolio of different asset classes, different investment styles, and still generate an income from them. It's also quite useful for the managers as well, because it frees them up to invest in the best opportunities that they can find from a total return perspective. So rather than having to be beholden to this yield target of it has to yield, it needs to have a good track record of dividends, it allows them to go and buy whichever stocks that they think are the best value in the market and then still be able to pay out an income to shareholders.
Right. So this has become a slightly more popular trend recently. I think there's about 20 or so trusts that have adopted this. JP Morgan is perhaps the best known house that has adopted this policy. And it's been one of the factors behind, I think, the popularity of its global growth and income trust, for example. So I suppose the big question is, those are the advantages, but does it work in practice? We know that in theory, in finance theory, it shouldn't really make a difference whether you pay out your income as dividend in one go or whether you actually take some money out of capital, which sometimes you have to do for an enhanced income policy. So what is the evidence that this actually works?
Well, you're absolutely right that it's a return of capital, really. It's just a way of sort of clipping profits and not running your winners and then paying this out as income. So in periods of market weakness, this is particularly a bit of a headwind because you're effectively selling low to then return income to shareholders. And also it can have implications for some investors who don't have their investments in tax wrappers like ISAs and SIPs, because you're effectively getting an income of which your dividend tax allowance is much lower than a capital gains tax. Although, if you've got SIPA and ISA, kind of irrelevant. But one thing that's particularly interesting at the moment is that lots of these trusts pay it out based on NAV. So they will set a policy, for example, they might say, right, we're going to pay out 4% in 4 equal increments based on the closing NAV of the previous year. So you know what you're going to get every 3 months for the next year. If that's based on NAV and it's 4% and the trust is trading at a 10 or 20% discount, you're effectively going to get 4.4, 4.8% based on their entry point. So because we're on such wide discounts at the moment, it's particularly encouraging. We did a little bit of work on trusts that have adopted these policies. I've seen that there have been numerous examples of trusts that have adopted them, and since then, their discounts have narrowed over the long term. Examples include Montanaro, Aberdeen Asia Focus that we touched on as well, and especially, like you said, the JP Morgan Trust, the UK Growth and Income Trust that operates in small caps has recently adopted it, and their discount has narrowed pretty consistently since. Ever since then, though, we have had a slightly weird year in that discounts started narrowing as interest rates came down, inflation was down as well, but then have since blown out again. So we think there's been a bit of a quirk of late that all these factors that should help discounts in the long term kind of unwound a bit in the last few months.
I looked at the performance of some of these enhanced income trusts recently. I've got about nearly 20 on this list, and some of them have done well and some of them not done well. So it's not a total obvious easy fix for anybody, but there are certain types of trusts that will benefit more than others, I think, from this. And in particular, as you say, it may be that because it appeals to people who want a regular, consistent income, which they can predict in advance, or at least they can be certain when the income is going to come in. They can't be certain when it's going to be, but they can be certain when it comes in. That is obviously an attraction, and that seems to work. I guess it's fair to say from what you've just said that the evidence that it actually does automatically help to reduce a discount, that's not so clear-cut.
Yeah, it certainly can do. I mean, ultimately, discounts are really a function of supply and demand of shares. And if you're adding a feature like this that investors like, and lots of investors do invest on the reason for generating income, this will add to the demand, really, and doesn't hugely affect the supply. So you can see why it would help narrow a discount, but it's not like an absolute dead cert. And it will depend often on the investment asset class and the sort of how the trust is doing that, as well as a load of macro factors as well.
Right. But as you say, it does appeal to the managers of a trust because it gives them a certainty about what they're going to have to pay at any time. And it, of course, fluctuates in line with their performance. So what do you think? Do you think it's mainly boards who are driving this trend towards enhanced income trusts, or is it actually the managers themselves who are behind it?
I suspect it's a little element of both. I mean, they wouldn't do this unless there was demand for it. So I think shareholders will be pushing for this. And I think they've seen from other examples of discounts narrowing soon after these policies have been put in place. It's just one way of going, oh, we've been asked to narrow the discount, and here's one way of doing it. For managers themselves, it's probably a marginal difference for them. Like, while the boards can be very proud of their dividend track record, and the AIC's dividend heroes are very proud to maintain that status, it's not going to be the be-all end-all for the managers, one suspects, unless you are the case of City of London, where it is a big part of the trust. So ultimately, it will depend on the trust basis. Then we'll look at it and be like, look, it's one way of potentially closing our discounts. And then also managers will like the fact that it frees them up. They're not beholden to having to find ever-growing dividends to support that dividend growth over the long term. And this takes the shackles off, takes the pressure off, really, for them to do that.
Okay, so that's one piece of research that you've done, which is interesting. Let's talk about another one, and that is looking at this very much debated issue of cost disclosure by investment trusts. There's been an awful lot of claims on both sides about how important the fact that certain types of investment trusts have to disclose their costs in a particular way, that, according to the campaigners at least, unnecessarily and unfairly inflates the cost figures that are given to investors when they're choosing what investment trust to buy. You've had the sensible idea of actually doing a survey of several hundred retail investors to find out actually how important cost disclosure is to them and what impact it's had on how they think about investment trusts, those that are affected by the cost disclosure issue. So tell us first of all, what was the size of the sample and what was the main finding?
Well, we sent our survey out to our audience of around 300,000 people. We had a decent sample who replied, and clearly they were showing dissatisfaction with the lack of clarity situation. Our results indicated that approximately half had previously avoided investing because of the fees disclosure. So that's a large portion of the audience that have gone, oh, I've seen the figure and don't like it or don't understand it, and been put off from doing that. We also saw that there was a lot of displeasure at the lack of clarity that platforms have added, by many deciding that they won't accept figures of 0% for the kiddery whilst the new disclosure laws are being finalised and put in place. But reassuringly, about 98% of our respondents said they either intended to add more or maintain their investment trust allocation following the changes of dropping those two EU directives applying to London-listed trusts. So that, in our opinion, is the key figure to take away. We're hoping that these survey results add to the great work that many industry players have put in place to help improve the charges and at least just put investment trusts on a level playing field with other vehicles. Ultimately, we just want investors to be able to make a fair like-for-like comparison between investment trusts and other vehicles. All have their pros, all have their cons. We just want to make sure that from a cost disclosure perspective, you are actually comparing apples for apples and pears for pears. And then investors can start making decisions based on the merits of the asset class rather than an arbitrary figure about rules and double counting of costs.
Yes, I thought it was interesting, some of the numbers you came up with. I mean, the first one, of course, is that it was only a minority of investors who actually looked at the key investor document where the higher than they should be figures are quoted. And it wasn't all those many years ago that John Kay wrote famously, the best thing to do with a kid is to burn it and not look at it. Seems that many investors have taken account of that. But those that do, obviously, they have noticed that the figure is quite high. But I guess the main point one has to make is that, of course, the people who say that they are most affected by this are wealth managers and people who have retail clients, because they have to disclose this figure prominently to their clients when they report what they're doing. And that's probably going to be the channel by which, if and when this new regime comes in right across the field, that will be the main channel which might actually change the share prices. Would you agree with that?
Yeah, I think that's very accurate. Ultimately, this wasn't a single factor that was holding back the entire industry, but it was yet another negative on top of a weak macroeconomic environment that was just putting off the marginal investor. And if you are a wealth manager or an IFA and you go and put a figure on a piece of paper and hand it to a client and it says 3% cost, that looks terrible, quite honestly. It might be the performance has been much better, or it might be the calculation methodology is very different, but trying to explain that and overcome a 3% cost is pretty challenging. Hopefully by at least clarifying the rules and then putting, like I said, on an even playing field with other trusts, you can compare like for like, and hopefully it starts bringing back in those marginal investors. It increases the demand for shares, and then we hope to have another factor in driving discounts to narrow in the sector.
At the moment, we still have this rather unsatisfactory state of affairs where the government and the FCA have said what they're going to do. They're going to tackle this issue, and they've given what we call forbearance to investment trusts to disclose the right figure, if you like, the cost figure that really matters to shareholders. But the platforms, as you say, or several of the platforms, are still insisting that the fund managers give them the higher figure. What's their reasoning behind that, and do you think it's actually justified?
Yeah, I think that what they're doing is looking at other regulations such as consumer duty and believing it might be their place to recommend clients. I think there's a bit of blowback and concern from some of the other issues we've seen in the platform world, such as with well-known, very large open-ended funds that stayed on best buy lists for longer than they perhaps should have done. And at which point they don't want to be taken to court and they're still going through the legal issues. Therefore, if they put on the higher figure and warn investors that it might be very expensive, and given the worst case scenario, they're perhaps not at risk of legal challenges further down the line if someone says, you didn't tell me that it's going to cost me 3% to invest in this. So I suspect there's a little bit of blowback in there about it. Whether it's the platform's place to be telling people where they should and shouldn't invest based on figures that they do or don't believe is questionable. But hopefully we get some new regulation coming in early next year, which clarifies the whole situation and clears this whole messy period up and starts to make the investment trust sector stand out for what it really is, which is a brilliant place to hold certain types of assets and generate great returns for investors.
And I think the final point to make on this has been going on for quite a long time. It's been, I guess, impressive to some, the speed with which the incoming government, the Treasury and the FCA have reacted to this. But it has been going on for a long time. And I think one could say with some vehemence that actually, if this cause is just, which many of us do believe, that the costs have been misstated, that it should have been dealt with a long time ago.
Indeed, yeah. It's been a real sort of feast or famine in terms of thing being done. There's been some fantastic campaigning behind the scenes from a number of industry players, of which we are very thankful to, who have worked tirelessly to try and get this done. It's been a very, very slow moving thing, only for it suddenly to be announced in the space of one afternoon and all resolved, only for it then to cause further issues with platforms and other people trying to look at other regulation to protect their clients or perhaps themselves. But hopefully we're at least through the worst of it now and we can start getting some new regulation in place and put this whole chapter close and put the book to bed.
Obviously, this impacts some sectors more than others, so particularly in the alternatives area, which has been suffering from a number of challenges in the last 12 months, including higher interest rates than many people had wished for. Do you think that they will be the main beneficiary? Will it be private equity? Will it be commercial property? Will it be the renewables? Do you have any thoughts on which sectors will be most affected by this or have been most affected by this?
Yeah, I think the ones that you highlighted certainly will be ones that will benefit from it. Anything really with higher costs, I suspect. Looking at some of the most egregious examples of high fees being reported under these disclosure regimes, it is in some of the sort of private equity growth capital spaces. So I think not having to report those figures and not having some of the papers pick up on those huge figures that are reported will help, and it'll stop putting people off. But I think broadly it will help across the board of just bringing down charges, and people won't go, oh, investment trusts are expensive, because they're not. They're a fantastic asset class that's been around for 150 years with good reason. So hopefully it is a boost across the board, as some areas will benefit more than others.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Let's turn then to the investment trust sector overall, which you and your colleagues research consistently and in depth. What are your thoughts about the election of Donald Trump as president in the United States? Obviously, the equity markets have been pretty strong since he won the election, and he's made a lot of promises about tariffs, about the dollar, about cutting taxes, deregulation, and so on, and made some interesting cabinet appointments, perhaps interesting being a slight understatement. What are your thoughts about the election, and how do you think that's going to impact across the investment trust universe?
Yeah, I think it's been a remarkable few weeks. As someone who's followed US politics for quite a few years, even I was taken aback by quite the scale of the victories. So it's interesting to see, and at least this way, unlike in 2016, there was a genuine possibility of it happening. Everyone wrote off the chances in 2016. So I think they've got a very clear plan. They've got a very clear direction of what they want. And also, as with all American politics, it's not so much about just the hot seat of the presidency itself, but also control of the House and the Senate, in which Republicans have a bit of a clean sweep. So I think with this, all the election promises that you saw of Trump can very much be pushed through. And unlike 2016, they're prepared, they've got the people in place, and they've got a plan to get on with it. So while in 2016, they had also a huge majority in many parts of the US government, little actually got achieved. So there is always that approach with caution caveat. But I think in this case, they're much better set up and prepared for it. On some of the specifics, Trump has been very clear about his plan, and that is he is pro-business. He is a deal maker. He will likely manifest this in sweeping tax cuts such as corporation tax, capital gains. And we expect this to be beneficial for the likes of big industry, especially big pharma. So I think one of the key areas we are looking at is the biotech space. We've also got the specter of Vivek Ramaswamy, who was a US Republican primary contender, but he made his fortune in the pharmaceutical industry and has been a very vocal critic of the FDA and the FTC, the two regulators in the space. He is now the co-lead of the Department of Government Efficiency, which is alongside Elon Musk, and is a new department launched to help reduce spending in the government alongside an existing government department that is meant to reduce spending, that will leave the irony of having two departments to cut efficiency to one side. And perhaps we'll look at what this means for drug licensing, where we expect to see a big cut in the regulatory hurdles for drug licensing and probably M&A as well. Now, the sector itself has a bit of a weak summer in anticipation of the election. Drug pricing is usually a key campaigning battleground. So as each party sort of got closer and closer and promised more and more, the sector sold off a little bit. However, it has jumped since. So potential of an easier regulatory backdrop has helped. We actually spoke to Elsa and Merrick, who are the managers of the International Biotech Trust, IBT, and they expressed the view that biotech is kind of emerging from quite a stagnant period into a bit of a new cycle, which has been supported by a more helpful outlook. Whilst politics is important, it's not actually everything from the sector, contrary to the belief of the Donald. And there have been other really positive factors in the space, such as rates. Biotech itself is very reliant on funding. You need to borrow money to go through these drug trials to then get out to market, and higher interest rates therefore are typically a headwind. So with rates starting to come down, these headwinds have eased. It has improved the outlook, though this is yet to manifest in the expected M&A boom that we're seeing. And we've got a bit of a weird dynamic in the sector, as that many of the big players in that sector have patent cliffs coming up, so their big drugs will become generic in a few years' time. So they are likely to be shopping around for smaller players to boost their drug portfolios and help extend that patent cliff coming up. Despite these positive factors, IBT itself is still trading at a relatively wide discount, around 12%. And that could help investors of not only helping returns from discount narrowing, but also seeing NAV pick up as well, especially if some of the M&A does come in, helping out with Elsa Marek's portfolio that is tilted towards a smaller and mid-cap space in the biotech sector.
Well, that's still to be seen, of course. We haven't seen much movement in the share price since the election, I think it's fair to say in that case. But obviously that could well happen in the future. I'm just looking through the list of trusts, how they performed since the election itself. And you're right to point out, of course, that the market did anticipate quite a lot of this before the election actually happened, at least in the last couple of weeks. So I guess it's no surprise to see that the trust has done best since the actual election is Seraphim Space. We've also seen strong performance from Baillie Gifford US Growth and some of the US smaller company trusts. Edinburgh Worldwide, that's a global smaller companies trust. JP Morgan US smaller companies. Schiehallion and Chrysalis also being growth capital trusts. So that suggests that basically some of the higher risk sectors in the investment trust sector are being rewarded. While over here, the UK specialist equity trusts have been basically not doing so well. But that's as much to do with the government here and events here as it is to do with the American election.
Yeah, I would imagine so. I think with some of those US smaller companies trusts, they are the other obvious beneficiary of a Trump government. He said he's going to do deals. He said he's going to cut corporation tax and the tax burden on smaller companies in the US, just because of the vagrancies of the state taxes and the federal taxes, is much higher for smaller companies than it is for large companies who have got that power to move themselves around and base themselves basically all in, I think it's Delaware or one of the Dakotas or something that's got the amazing tax regimes, whereas small companies don't quite have that flexibility and availability. Therefore, having a cut in corporation tax will have more of an impact on their bottom line. So you can see why those areas have benefited. Moving on to the UK, the country has struggled a little bit. There seems to be an overwhelming sense of negativity stemming from some of the political issues. If you had gone back a year and told people what's going to happen, they've gone, oh, great, so we've had a change of government. Everyone hates their government. We'll have a budget that does this and we'll be looking positive, right? But seemingly it just needs to be in this negative doom loop of bad news begets bad news and everyone's getting very negative on the country. But take a step back, we've got half decent growth, consumers in a good place, there's gentle wage inflation, so hopefully disposable income starts to increase, interest rates are coming down, inflation's back near or at target. But I think the foundations of the UK are actually in fairly good place. We just need to have a bit of a change in the mood music. But I think international investors have started to recognise this, hence why we're seeing yet another flurry of deals going over the line. And previously, in the last 2 years, you've had the marginal investor constantly selling out. So the multi-cap funds and trusts have been like, well, sell small caps because we're having a recession. We technically had a recession, but it seems to have recovered since. So I'm hoping that those investors start to come back in.
In the short term, of course, smaller companies do have to wrestle with some of the things that the government has chosen to do in terms of higher business taxes, which come straight to the bottom line, essentially, in national insurance contributions and higher minimum wage and knock on differentials and so on. So it's certainly not been quite as positive as many were hoping, but they do certainly remain cheap, that's for sure. Let me ask you then finally about one of the other Trump signature noises, if I can put it that way. He's very keen on establishing tariffs and looking at trade barriers, particularly against the Chinese, but also possibly against the EU and the UK. What's your thoughts about how this leaves Asia and China in particular? Is that going to be a significant drag on their performance from here?
Yeah, I think the election of Trump is not exactly great news for China and Asia, but then also Harris was particularly negative on China anyway. I think it's one of the very few things that US politicians on both sides of the aisle actually agree on, and that is to control the influence and power of China. So ultimately, the outlook wasn't going to be brilliant anyway. But I think arguably the worst case scenario is already in the price. Trump has not exactly been shy of his opinions or approach for China, but like I said before, he is a businessman and he loves a deal. And I think the current touted level of 60% tariffs, although he's not woken up yet and truthed some new rules, so it could well change between me saying this and it going out. But I suspect it will just be a negotiation and both sides need each other. Not that they're willing to admit it, but the US needs China and Chinese factories to make its products, and China needs the US and its power to buy all this stuff, keep its population going. So I think there will be a deal to be made and find some common ground. They could take it back to their populations and frame it as a win. And if they do, that will at least provide some certainty to markets, which should be solace to investors and hopefully be reflected in a recovery. I think the other angle you can take on it is that China has been having a very weak couple of years, especially with the property sector, which has caused a negative wealth effects and depressed consumer sentiment over there. The government has at least acknowledged this now, has brought its stimulus measures to try and support certain areas of the economy. And that's hopefully going some way to resolving the deflationary problems and weak consumer sentiment. I think the mood music is very against China, very understandably, but there is a way for them to play their way out of this. So valuations are reflecting that negativity. So it could be an opportunity for those who are willing to be brave.
So that was Ryan Lightfoot-Aminoff, who is an investment trust research analyst at Kepler Partners.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.